Ari Sass, why do I want to be in a buy right or a covered call fund now when all the indexes seem to be hitting new highs?
Sure. So if you look at the S&P now, it's trading at about 17, 18 times earnings. So clearly we're in the later stages of a bull market as opposed to the early innings. At the same time, you have interest rate risk here with interest rates perhaps rising due to Fed action. So we think the market's fairly valued and could get more volatile. In that type of environment, a covered call strategy not only offers some downside protection in the market, but also more stability through income generation as opposed to looking for capital appreciation in a fairly rich market.
How does your MD Sass Equity Income Plus fund differ from other covered call funds in the market?
Sure. So we think we have a fairly unique strategy for two reasons. One, we're actively managing this portfolio. So we're buying carefully selected, thoroughly researched stocks as opposed to a buy right on the S&P 500. So for one, we think active management is a critical element, and we do have a long-term track record in long-only investing. The second difference is we buy put protection on the index as well. And so what other covered call strategies lack is significant downside protection. We offer that by buying puts on the market, and with the VIX, or the implied volatility of the market, fairly cheap today at 12, 13, we're buying very cheap insurance on the market.
Well, let's talk about some of the stocks you like. And interestingly enough, you like some stocks in the packaging industry, Rock-Tenn and International Paper.
Right.
Why are these stocks in an area that you like?
Sure. So they're in the very sexy business of making cardboard boxes, which, quite frankly, for this type of strategy, we like consistent growers. We don't like a lot of volatility. The cardboard box industry is actually an oligopoly. There's really three main players in this business now. It used to be highly fragmented. And we think an oligopoly is just a better industry to be invested in than a highly fragmented one. Second, in the case of Rock-Tenn, they're merging with Midwest-Vaco, and we think the cost synergy targets they gave out are way too low. They're also going to spin out a specialty chemicals business, which we think is worth probably 12 times EBITDA. The stock itself is about 7, 8 times EBITDA. So we think there's some catalyst to unlock value. If you do a buy right on International Paper and Rock-Tenn using at-the-money calls, you can generate what we call a standstill return of 13 to 14% annual. In other words, if the stocks don't move, the dividends plus the call premium get you 13, 14% kind of return.
Another interesting area that you're bullish on is outdoor advertising.
Right.
And these are names like Lamar and Outfront. Talk about these.
Sure. So we think there's a misperception that all forms of traditional advertising medium are going away. And we've seen a decline in newspaper, we've seen a decline in print, and to some extent television advertising. But outdoor advertising is a whole different beast. And we think this is one that has market share gain opportunity, not decline. The fact that Apple is one of the largest consumers of outdoor advertising tells you something about the benefit of outdoor advertising. These stocks have 4 to 5% dividend yields. They're REITs, and we think they're a bit unknown to the typical REIT investor, but as people get comfortable with the business model, we think the yields on that should be a lot lower. Again, the buy right on Lamar and Outfront Media is about 13, 14% annualized return by selling at-the-money calls.
I'll take that any day of the week. Thanks a lot, Ari.
Thank you very much, Greg. Appreciate it.
And thank you for watching The Street.